All right, we can go ahead and get started. I'm Andy Reynolds, COO, financial advisor partner here at Ballast. Joined today with Frank Yoswick, who is our Director of Estate Planning and Tax, John Boardman, founder and CEO, Cameron Hamilton, our partner and Director of Financial Planning. So we thank you guys for joining us for our webinar today titled The 100-Year Family Wealth Plan. We had the thought of doing this. We wrote an article in our most recent magazine. Hopefully everybody has seen by now about generational planning and generational wealth transfer and planning for our families and family businesses and whatnot. We had this idea just because we've been talking to a lot of people about generational planning among wealth and whether it's a business or inherited assets or found money from family and whatnot. We just want to talk a little bit about that with our clients and try to always be thinking forward and planning for them. So today, just to get started, let's just throw it out to the group. What is generational planning? What is generational wealth? It's something we hear tossed around more and more nowadays. So just as we think about it and talk about it with our clients, let's just start there. What is generational wealth?
I'll jump in. I think with clients we work with today and really most individuals that have a balance sheet above a certain level, what we know, the data tells us, is that most people actually created this wealth on their own. That most millionaires today, let's just say, use that term, did not come from an affluent background. So creating a plan has created a new dynamic in their family where they have to think about how they're positioning this transfer of assets to a surviving spouse or the next generation or whomever they want to benefit. And it brings up a lot of questions about, the principles that they're trying to continue from this generation to the next. So there's the blocking and tackling and the mechanics of the plan, but there's also the principles that go into it and what messages are you trying to perpetuate to that next generation. And I think that's something that too few families spend time talking about. There was a statistic I read that only 10% of families actually discuss their wealth transfer plans with the next generation, which I think is a huge mistake. So there's a lot that goes into it. I know we're going to go in from here, but I'll send it to others in the group to
It's
comment.
funny you use a 10% statistic about people not talking about it to bridge the wealth across generations, because another one that gets thrown out a lot is 90% of wealth doesn't make it past the third generation. So I don't think those two, that correlation probably is by accident. Even our clients who are on the more affluent side, very few of them have wealth that couldn't be destroyed in a generation or two. So most of our clients get towards a position, whether it's during the middle of their career or in retirement, where it's very reasonable to start making the next generation a priority. But just as important, like you kind of mentioned a little bit, is equipping the next generation to deal with that and be a steward of it. And that's the question that a lot of my clients is on the top of their mind, is how do I help them without hurting them?
And I think, we call those vision meetings. Meetings where we're sitting down with multi-generations, and maybe we're helping provide the leadership of passing on those values, helping define what that stewardship looks like and how to incorporate the next generation in decision making and whatnot. As we've done that with different families, what are some examples of those conversations and how they've gone with different family members and where you can get the next generation involved, and possibly bring in children to help start making decisions, whether it's charitable or whatnot? How have those conversations gone that you guys have had with people in the past?
I'll jump in here. I've seen that happen a lot of times with the estate planning conversation. So, once we've got our family's wealth taken care of, my spouse and I, we're thinking about passing on to the next generation, and I'm going to name this person as the executor, this person as the trustee. Well, that's a great time to pull them in and say, hey, do you want this responsibility? And oh, by the way, here's kind of what our thought process is for the next, what you guys should be doing or what we would like you to do in the next generation. So I think that's a very good intro at that point to bring in that next generation and really kind of say, hey, here's what your responsibilities would be, and then here's kind of what we would like to see happen with our wealth going forward.
Yeah, I think people typically, and just working with a lot of people as they've settled or we're settling the estates of someone that's passed away, helping the family do that. I think people underestimate the amount of conflict that can be created in a family that's trying to work through the plans that have been laid out from that deceased person. And so education, transparency to some degree. It doesn't have to be a full transparency down to the penny of each account value, but just a sound understanding of how the assets are going to be handled. This is really important if there are family business assets or illiquid assets that are difficult to value and potentially they might be co-owned by beneficiaries. We see that from time to time. And in those situations, I think it's critical that there's a shared understanding of how these assets are going to be transferred and governed. And we haven't gotten into governance a lot, but governance of a plan is as important as the plan itself. And to Frank's point about naming a trustee or an executor, and typically the trustee is the one that has the long-term job. Are they equipped? Do they want it? Do they have the right relationship with the people within the family to make the proper decisions for them moving forward? Or are they just going to be a yes person? Because if they're just a yes person, it's can prove very counterproductive. I've seen some nightmare situations in the past. I cut my teeth in the trust industry, and if you don't have the right trustee named, you can run into a situation where they're sort of afraid and they're concerned about upsetting the dynamics of the personal relationship they have with the beneficiary, so they often don't make the proper decision. So there is a lot that goes into that, and we've spent a lot of time talking with our clients not only about the structures that you're putting in place for the governance of the assets, but also, is this appropriate for an individual in the family or a family friend, or do we need to think about an institutional third party that can come in and help to keep the peace? And oftentimes it can be worth the additional cost that might entail.
Yeah, I'll just add a quick story that I thought went really well. Time will tell. I hope it will go well. But, Frank and I were working with a client who had a family farm, and the family farm was probably going to be an illiquid asset. One of the children lived on the family farm and has farmed the family farm, but it was purchased with family money. The child living on the farm had improved the farm, and the other child was no longer living in the state. And the initial plan was to split the farm 50-50 between the two siblings, which, as you can imagine, could create some issues. So transparency, John, I thought is a very good word, because a lot of parents don't want to talk about money with their kids because they're afraid that, that it may make them lazy, or not as motivated to build their own. But in this case, we're able to have transparency, and we left some of the numbers vague, but transparency among the assets and around the farm, and came to a really good conclusion where basically one sibling, although initially maybe they thought they wanted more to do with the farm, really they just wanted to be able to visit the farm if it was still in the family's name, and the other sibling wanted to live on the farm. And so we're able to give one sibling the farm, make the other one whole, and then split the rest of the money down the middle. And I think just bringing in the attorney, having everybody have a voice at the table, I hope it reduces any friction in the future. I hope it, really creates this optimal outcome, which could have been, suboptimal. And especially if you're dealing with that when someone's, going through an estate process where there are a lot of emotions at play, having the foresight to think through those outcomes, I think is really important.
I'll tell you what key statement you said stood out to me, Andy, just now, which is time will tell. because we're not sure how it's going to end up. But what is exciting for me about what you shared is we didn't necessarily plan for every contingency from what happens from today going to the end of time. That balance sheet from the parents might change, but they have a good solution for today. And a lot of times, what we run into is a paralysis because we're, well, this could change, this could change. I really get excited when somebody can say, let's just get something that's good enough for today and not let perfection be the enemy of good. And if the financial assets are 5x the farm one day, that'll be great. But at least they're not in a situation where one sibling is in charge of a farm and can't pay the bills, and that type of situation that's just clearly going to put people at odds. So
That's a really good point. I think there is a lot of misunderstanding about trust planning and estate planning in general, that when you do it, it's sort of in ink and can never be revised. Most types of trusts are written unfunded and do not actually get activated until someone passes away. So they can be revised as your knowledge of your family changes. So we've had instances where we might have a client who has 3 children, one of who is maybe struggling a little bit more than the other, and we want to have some additional provisions around that trust that could be changed if that circumstance changes during that person's life, and or having triggers inside of it that would allow someone to make the decision to revise that if that person became educated or fully employed or whatever it may be. So there's a lot of flexibility that can be put inside of it. I think getting back to the governance question, I'm a much bigger fan of having proper governance from a leadership on a trust standpoint than I am having such strict provisions within a trust that prevent any type of flexibility for the trustee down the road as they're operating that. I've seen attempts by individuals to, I want to say, control from the grave, but that's effectively what they're trying to really sort of manipulate how the family will deal with every aspect of their financial life moving forward. And that can actually prove counterproductive. You should have general principles language inside of the trust, but giving proper, that, in my opinion, proper flexibility to the trustee to make the proper decision for the family.
Yeah,
And what probably happens in those overcomplicated situations is the one thing they didn't think about, that becomes the issue. It's there's no way to predict every single possible thing that may arise. And, we've seen that a bunch, good intention, naming, you know, Joe Smith as trustee, but then Joe Smith as trustee, wants to dictate things his way, and there are definitely complications that can rise from not having the right people or the right flexibility in those estate planning documents.
Yeah.
I want to jump in here real quick. John, I love what you just said about the general principles. I mean, having these conversations with the next generation and even among, your current generation about general principles is super important. We've had meetings with clients that came in and we're talking about the assets and realized that the husband thinks one way and the wife thinks another way. And they just never sat down and talked about it together. And so if that happens to a married couple that's been married for 30, 40 years, that can easily happen between generations. If you're talking about parents to children to grandchildren, just what are your general principles? What is the kind of the family thought process here? Let's all talk about it and make changes as necessary while we still can make changes before someone passes away and something does become a little bit more set in stone. Getting that all out to where everybody can sort of get closer to the same page is always a good idea.
Before we move off the estate planning talk, John, you'd mentioned corporate trustees, and through my career, it feels like there's a period where corporate trustees were more popular. They become kind of undesired for a while, and now they're becoming more popular again. I think part of that has to do with people having accumulated larger balance sheets, and so maybe the fees associated with corporate trustee is more palatable relative to the benefits that they get. But talk a little bit about corporate trustees and the benefits that we see from them, and it not having to be the $100 million trust, but maybe families who've worked hard, have accumulated, self-made, and have obtained enough to justify having a corporate trustee, if nothing for else than just simplicity?
I think one of the reasons corporate trustees sort of went out of favor for some time was just rampant turnover inside a lot of these institutions. So you would have trusts that were drafted 30, 40 years ago, naming a specific bank, which would typically have the trust company or the trust division inside of it. And then by the time the assets actually become overseen by that trustee, the people have changed. Likely the name on the shingle's changed. It's been acquired. So you saw people sort of going away from that and going more towards individuals. Since then, we've seen this uptick in independent corporate trustees, which, for our business is great because we can match these independent trustees with the family dynamic that we think is, that would match up with that. And it's a lot more cost effective, and it becomes a three-legged stool between the corporate trustee, the beneficiary, and then the investment manager being the third leg of that. The investment manager or trustee can be independently replaced. Before, when you were working with a trust division of a bank, it was kind of you take it all. You get the trustee services, and as part of that, you get the investment management. So a lot of clients and attorneys have changed their perspective on this and are going for more of this nimble approach where there's some accountability that's created when you've got multiple parties inside of a relationship now versus just having one bank being named. I mean, some of these banks, we could speak to Lexington as an example. There's examples of trust companies that literally have almost no presence here, that 25 years ago had 60% market share. So those wills and trusts that were drafted decades ago often just don't match up with the current backdrop.
Yeah. Let's shift gears a little bit. Let's talk about charitable planning, donations. We had questions about endowments and donations to nonprofit organizations. I think we've written multiple times about this, that we've observed that our happiest clients tend to be the most charitable clients, the ones who think greater than, their own balance sheet, their own financials, and are involved in something bigger than themselves. As we think about multi-generational planning, generational wealth, involving the next generation, involving charitable planning, what are some of the conversations that you all are having with families about how to incorporate charitable planning, when to incorporate it, what family members involve? What are some examples of conversations you all are having?
I'll tell you, it needs to happen all the time, not just in your will. Because back to the beginning of the call, John talked about values. I think a great way is to live it with the family as the kids become adults. So my daughter, the only time she sees cash is when it goes in the plate. And that's not even where we give the majority of the money, but we're trying to teach. And most of our clients, and really almost all wealthy Americans, don't need to be creating their own private foundations. So the model that fits most of our clients is partnering with a community foundation, and having just a donor advised fund. And that can be training wheels for teaching the family about charitable giving. So, that's where we can give assets and give a tax benefit and separate the action from making a gift as the IRS is concerned and actually granting the money to the charity. So that's great for all kinds of planning situations. I actually wrote an article today that I think we're going to be publishing, but it also introduces an opportunity to educate the family about here's what we're doing, here's why we're doing it, and also lets the parents, if they want, and are fortunate enough to be in a situation where we're deciding how much money to give the children, to let them kind of be a participant or an auditor of that conversation. And here's what's important about these charities that we're supporting, and here's how we do it, and you can come help be an advisor to that process.
I had an example just a couple weeks ago that popped up, and I think this is a really good way of sort of thinking about legacy in a slightly different way. But we had a client pass away, and one of their wishes was to leave a scholarship fund for a student from the school that they went to, which was a small town, she had had a successful career as a public school teacher, and she wanted to have a scholarship fund established for someone coming from her hometown that was going to pursue a career in education. And that may not be, as massive as maybe we're thinking about it on today's call, but that is a perfectly executed legacy plan. She loved her career, she loved her hometown, and she wanted to give the same opportunity to somebody who had to take the same path that she had in life. And I think, too often people think that legacy planned is this really big, grandiose thing. To Cam's point, not many families need a family foundation or a private family office to run their affairs. We can get very granular with some of these ideas, and really make them super efficient for things that are just important to them. There is an education aspect, no doubt, to the family and these planning concepts, but in many cases, it's just this cause, this organization is important to me. I've volunteered doing it forever. I worked there forever. I want to make sure that they have my support, for the foreseeable future as well. And so it's really, I know from our perspective as advisors, I love having those conversations because I think people often underestimate the impact that they can have on a charitable organization. It doesn't require, I mean, it's been remarkable, I think, how much positive impact we've seen in clients that have started pursuing some of these charitable concepts. And not all of it has to happen at the end of your life. In fact, I think it's a better idea to start it during your life. I think legacy can start now. It doesn't all have to be triggered, after you're gone.
And there are a lot of trusts you can use to do that, to take advantage of different tax laws and whatnot through, charitable gifts today that you get income off of for a while. I think that the charitable planning from a parent selfish standpoint, it enables you to use a lot of tools to your benefit. So maybe you're donating appreciated stock. Maybe you're using a qualified charitable deduction, so you're saving taxes. Maybe you're involving your kids or grandkids and teaching them about money and having them research charities and having them start to think about money and understand money and seeing money and being involved. Maybe you're identifying areas of your budget where you can prioritize things that are bigger than yourself. So I always find that being a cornerstone of a lot of people's planning, and that, we want to start there because it can influence so many different areas of people's lives, especially around the tax side of things. So transitioning just slightly, Cam, you've written the most probably about Roth money and taxes within our practice. You are the director of financial planning. Talk a little bit about, legacy planning and taxes, and maybe we can tie in some asset allocation, where to place assets when we're thinking beyond 2025, beyond 2026, and we may be thinking about 2050, 2075 when we're trying to make decisions today.
Yeah. Well, let's just dispel the old concept of Roth money is for young people who don't make money, right? So, when my little sister babysat during college and we put all her earnings into a Roth, that was a good move. But, we also have seen clients who have been high income earners, that our math says it makes a lot of sense for them, sometimes even in the top tax bracket, to be utilizing Roth money, because just what Roth is paying our taxes today and making it tax free forever. And it gives us that tax free bucket that's never going to be subject under today's laws to require distribution. So it's not going to start to be eroded in your 70s and hopefully distributed, like the government wants to do with pre-tax money. So today Roth money that I have, I'm in my 30s. Probably every Roth contribution I've done inside my 401k is not going to get spent until 10 years after me or my spouse dies, the second to die, just because of the nature of, we're going to have any opportunity along the way to distribute those funds, but it's probably going to continue to make sense for us to have tax-free deferral on the Roth dollars. So ultimately, though, our goal is lifetime tax minimization. And it's a treat if we can do that across 2 generations. So now we get to know, okay, do we have a CT surgeon on one side and a social worker on the other? Maybe we start to optimize the parent's balance sheet to be transferred to 2 different charitable beneficiaries. And then we're also looking, during the parent's lifetime of, does it make sense to ever pay tax now in order to try to not pay tax later? So a lot of times we have a very common situation of somebody retires prior to RMD age, which is 73 now, and we have the ability to voluntarily pay tax to turn pre-tax money into after-tax money forever. A lot of our clients have just too much pre-tax money because they did what's the prudent thing to do, which was max out their retirement accounts. But it gives us opportunities to try to optimize the balance sheet and just try to really, the whole goal is put income into low tax brackets. So that's either during your life or get assets that are taxable, they're going to get stepped up on your death, or if it goes to the next generation, put it in the lowest tax bracket possible. And then hopefully your kid also has a good partner that's sharp enough to help them strategically distribute it during their years. If you have a medical resident that inherits money, go ahead and distribute it all before they get the big salary. So we have this 10-year rule we can play with now. So there's a lot of room to optimize.
One thing I'm a big fan of, and fortunately a lot of people are doing this, is IRAs and 401ks are not really efficient for transfer to the next generation. Just because of the Secure Act now, non-spouse beneficiaries have to take the money out in 10 years. So to Cam's point, if it's in Roth, that's tax-free distribution. So, by the end of the 10th year, but if it's a pre-tax account, they do have a tax liability associated with it. So a lot of people are actually moving their charitable bequests away from their wills and trusts and putting them in their retirement accounts because they avoid the taxable income on the distribution, and then that distribution can go directly to the charity. And then they use their taxable assets or Roth assets for purposes of generational transfer of assets. So either via the step up on that they get on the non-qualified assets or Roth being tax free. So I like that too, because a will and a trust is a little bit heavier lift a bit of a heavier lift to adjust and change. Whereas a beneficiary designation can be changed quite simply on a retirement account. So people's desires change, and the organizations or charities or whatever that they want to benefit could change. And so that beneficiary designation becomes a little bit easier to amend.
Yeah.
And just real quick, as far as rules, QCD is a donation from an IRA, and the minimum age is 70 and a half. And I tell clients all the time, if you're giving cash and you're 70 and a half, let's talk and just make sure that this is not something good, because more often than not, it's optimal.
Tying John's comment there into Cam's comment as well about the donor advised funds and the ease of making adjustments without having to redo the estate plan. With a donor advised fund, you can go in and tinker with who the ultimate beneficiary, who the ultimate charity recipient would be. Then you can set your beneficiary designation to be, X percentage goes to this donor advised fund, and you can do all of that without having to, get on the attorney's billable clock and redo your whole plan. You can go in and make substantial changes and substantial tax savings for the next generation pretty easily without having to do the whole estate planning business.
I think without a doubt, it's pretty clear if you're trying to plan as the most optimal outcome, you have to be thinking beyond your generation, right? You have to be thinking to the next kids. Especially, I was just thinking as we're talking, if you have a large IRA balance and your normal life expectancy age, well, how old are your kids when they inherit that IRA? They're probably in their peak accumulation years. So maybe you defer that income at middle tax brackets but now that income's coming out and sitting at the top of their income and maybe their peak accumulation years. And so I think thinking through all that, that's where we have older clients making IRA conversions. And at first comment, people kind of sit back, they're like, well, no, that's what the young people do. And we're like, no, that's what we need to be thinking about so that we can optimize these outcomes across multi-generations. And that's something, again, it's not for the $100 million only households that we want to be thinking multi-generationally. It's really, for most of the clients we're dealing with, it's probably everybody to some degree. All these tools can be implemented. It's just how many of them and to what extent do we implement them. So as we think through multi-generational planning, the 100-year plan, is there any concluding thoughts or any topics that you all want to add to today's conversation?
I wanted to
This
mention.
is Nick.
Oh, go ahead. Go ahead.
I got one more, just
I got a quick.
planning, since I'm the planning guy, charitable remainder trust, where we give appreciated assets and we get a stream of income and then the charity gets it at the end. We love those, and we love them even more when interest rates are high because the math works better. So just, if we've had that conversation with you, if you've never heard of it, it feels like a fit. Interest rates, although we don't see them coming through the floor, we see them going down over the next 5 years. So while stocks are up and interest rates are up, it's an optimal time to think about that.
I just wanted to say, we've talked and, big words about how families need to be thinking about their legacy. This is a conversation that we can facilitate for you. And we can do it with just, the most senior generation, or we can involve, the children and next generations or even grandchildren. Have done up to 3 generations in a room together. And it's great. There's typically some preliminary discussions you want to have before you have everybody in the room like that. And I think it's really important, if you have any type of asset that you want to make sure is taken care of and stewarded to the next generation, be it a farm, a business, a home, whatever it may be, that conversation cannot happen soon enough. There are too many examples out there because someone passed away unexpectedly and there was not an understanding of the next generation, where businesses have faltered because there was not a proper conversation about how the business was going to be taken care of or how the farm was going to be taken care of. And it's an easy conversation to punt on because no one likes to talk about their own demise, but it is one of the best gifts you can give to your family. And it's a selfless thing to do, to just broach the idea that one day you will not be around, and we need to have a dialogue about, how our family takes care of, what we've worked hard to accumulate. And I see a lot of people, I think Cam mentioned paralysis by analysis. That is a very common thing in estate planning, and any type of financial planning for that matter. But particularly when you're talking about end of life planning, a lot of people just, it's a thing they want to do, but oftentimes have a hard time prioritizing.
Thanks, guys. As we recap today, I would just kind of conclude with, I think a couple main themes coming out of this is transparency, sharing stuff with others, as you were just referring to, John. Leadership among professionals, leadership to your children, to the next generation, helping teach them, what your values are, and then using tools. We have a lot of tools at our disposal. Estate planning attorneys have a lot of tools at their disposal. Tax advisors have a lot of tools. There's a lot of tools out there, and depending on what we're trying to accomplish, if we optimize all those tools, we can usually come out to a better place. So we just want to thank everybody for joining us. Obviously, don't hesitate to reach out to us with any questions that you all have. We enjoy doing these webinars. If anyone has any topics they want to hear about, feel free to reach out to us. This will be published on our website and on our YouTube channel, and we'll email it out to clients. So thank you all for joining us today.